Welcome to the video. Today we will walk through why draining your health savings account for quick cash is a costly mistake, what the triple tax advantage really means, and how to turn your HSA into a flexible, tax-free powerhouse for your future. And to begin, we will set the stage with a quick agenda and then dive into the fundamentals, costs of convenience, and the optimal strategy to maximize long-term benefits. Here is our plan for the video. First, we define what an HSA is and why it is powerful. Next, we break down the triple tax advantage. Then we quantify the cost of convenience when you cash out early. After that, we present the optimal long-term strategy and practical receipt archiving tips. We will also use diagrams and examples, run through a couple of quizzes, and finally summarize with concrete next steps. Let us begin with the basics. An HSA, or health savings account, is available to those enrolled in a high-deductible health plan. It has distinctive tax features that make it stand out from other accounts. These include deductions on contributions, tax-free growth on investments, and tax-free withdrawals for qualified medical expenses. It also provides flexibility to invest in index funds and to reimburse yourself later for past qualified expenses if you keep your receipts. Of course, there can be provider fees, and there is always market risk when you invest. Now let us break down the triple tax advantage. First, contributions reduce your taxable income. Second, investments inside the HSA can grow without incurring taxes along the way. Third, when you withdraw for qualified medical expenses, you pay no taxes on those withdrawals. Additionally, the Reimburse Anytime rule allows you to reimburse yourself years later for past qualified expenses, provided you have proper documentation. Next, let us consider the cost of convenience. Pulling a few $1,000s now, even if you have receipts, means giving up many years of tax-free compounding. In practical terms, that small balance today could have become a much larger tax-advantage sum by retirement. You are effectively trading an asset that might become $40,000 to $80,000 or more for a modest taxable return in a regular high-yield savings account. The smarter approach is to reserve the HSA for long-term medical and retirement needs while using a standard emergency fund for immediate liquidity. This flowchart outlines the decision process. It starts by asking whether you need cash now. If yes, the recommendation is to use your high-yield savings or other liquid funds. If you remain tempted to tap the HSA, the diagram warns that doing so means you forfeit tax-free growth and reduce future flexibility. If the answer is no, the diagram shows that you should invest the HSA in low-cost index funds, archive all qualified medical receipts, allow the funds to compound for years, and then reimburse yourself tax-free later if you need to. Here are approximate values of a $6,000 balance compounding at different rates. At 5% for 20 years, the balance is roughly $15,920. At 7%, it is about $23,218. At 9%, it is around $33,626. Over 30 years, the amounts climb to roughly $25,931, $45,674, and $79,606 respectively. Over 35 years, they reach about $33,096, $64,062, and $122,411. For comparison, a 3% taxable equivalent might land at around $10,837 after 20 years, $14,564 after 30 years, and $16,860 after 35 years. These figures are estimates and do not account for fees, taxes outside of the HSA context, or market variability. Nevertheless, they illustrate how compounding inside an HSA can create significant value over time. Now let us present the optimal strategy. First, keep your HSA invested in low-cost, diversified index funds according to your risk tolerance and time horizon. Second, pay current medical costs out of pocket and meticulously archive your receipts for every qualified medical expense. Third, at any future point, you can reimburse yourself tax-free by submitting those archived receipts, enabling you to time the reimbursement for when it is most beneficial. Here is a practical implementation checklist. First, select an HSA provider with low fees and access to diversified index funds. Second, invest in low-cost index funds according to your risk tolerance. Third, pay for current medical needs from regular funds and refrain from using the HSA debit card. Fourth, scan and save every qualified medical receipt. Fifth, back up those records in at least 2 places, such as a cloud drive and a local drive. Sixth, maintain a tracking spreadsheet that logs date, provider, amount, and purpose. Seventh, conduct an annual review to ensure contributions, investments, and documentation are on track. Finally, strategically time future tax-free reimbursements if and when you need them. Next, let us cover practical documentation tips. Use a consistent folder structure such as an HSA receipts folder organized by year and provider. Use descriptive file names with date, provider, amount, and a brief description. Consider including a small README file in each year folder with totals and notes. Back up your documents to the cloud and to a local storage device. And periodically test that you can restore files. When available, save the explanation of benefits alongside the receipt to make later reimbursements straightforward. This timeline depicts a typical HSA journey. It begins when a person enrolls in a qualifying high-deductible plan and opens an HSA in their mid-20s. Through their 30s and 50s, they contribute, invest, and archive receipts while avoiding unnecessary withdrawals. In the late 50s and early 60s, they may add catch-up contributions and review their documentation. After age 65, the HSA can be used for Medicare premiums, deductibles, and other qualified medical expenses, while archived receipts enable tax-free reimbursements. The key theme is consistent investing, diligent documentation, and long-term compounding. Let us compare an HSA with a high-yield savings account. The HSA offers a triple tax advantage, tax-free growth, and tax-free withdrawals for qualified medical expenses. It also supports long-term compounding and allows reimbursements at any time with proper receipts. By contrast, a high-yield savings account provides taxable interest, high liquidity, and no special tax advantages. It is well suited for immediate emergencies, but not for maximizing long-term value. Therefore, use a high-yield savings account for short-term needs and reserve the HSA for long-term medical and retirement goals. Before moving to quizzes and wrap-up, here is an important disclosure. This video is strictly educational and is not financial, tax, or legal advice. Individual circumstances vary, and you should consult a qualified professional who can evaluate your specific situation before making decisions. Quiz time. The question is, which item is not part of the HSA triple tax advantage? The options are: contributions are tax-deductible, earnings grow tax-free, qualified withdrawals for medical expenses are tax-free, and employer match is guaranteed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is employer match is guaranteed. While some employers may contribute to an HSA, that is not a guaranteed feature, and it is not part of the triple tax advantage. The triple tax advantage consists of deductible contributions, tax-free growth, and tax-free qualified withdrawals. Next, let us address common myths. First, you do not need to spend HSA funds in the same year. You can reimburse yourself later if you keep receipts. Second, HSAs are not limited to high-income individuals. They are available to anyone enrolled in a qualifying high-deductible plan. While investing involves risk, a long-term diversified approach is often appropriate for many investors. Fourth, you cannot reimburse without proper documentation, so keeping receipts is necessary. Here is another quick quiz. True or false? You can reimburse yourself decades later for qualified expenses as long as you saved valid receipts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is true. The Reimburse Anytime rule allows you to reimburse yourself in the future for qualified medical expenses incurred after the HSA was established, provided you maintain valid documentation. Here are the main points to remember. First, HSAs provide exceptional tax benefits when held for the long terms. Second, tapping the account for quick cash gives up decades of tax-free compounding and future flexibility. Third, the core strategy is to invest, archive receipts, and reimburse later when it is beneficial. Fourth, maintain a separate emergency fund for short-term needs, and keep the HSA focused on long-term medical and retirement objectives. To wrap up, respect the triple tax advantage, allow compounding to work over time, rely on a separate emergency fund rather than draining your HSA, and document every qualified medical expense so that future reimbursements are easy and tax-free. Following these principles can dramatically increase your financial flexibility later in life. Thank you for watching. If you found this helpful, please like the video, share it with someone who needs to hear it, and subscribe for more. Add your questions and your best HSA tips in the comments. We appreciate your support and look forward to seeing you in the next video.